trading setups. Now notice how I say high probability trading setups. I'll come on to that later on. Now it's essential to understand the general idea of structure, and then we'll connect it later on down the line to the overall supply and demand of the market and explain why price moves and does what it does. So yeah, when price moves to the upside, that is called bullish structure. Okay, you'll see a series of higher highs, higher lows, and structure breaks. Now when you see a higher low followed by a higher high, it's essentially just breaking a previous high in order for price to create a new high, and this will continue to do this until either the trend is just exhausted or just generally switched into the downside. Okay, I'll cover why price, obviously, like I said, the overall supply and demand, I'll cover that in a different video. Okay, now this is obviously more of a picture perfect example, and prices maybe as easy or as simple as this may look, and we know when we compare things that look picture perfect to a real life example, it never really looks the same, right? It's like by learning Wyckoff of Google Images. So again, in a quick recap, we just cover this. So this HH is a higher high, HL is a higher low. Okay, now as long as price is moving to the upside and not breaking below the previous high lows, we're still in bullish market structure, and what it's doing as well is breaking structure to the upside. Okay, now I'll cover what breaker structure is in the type 1, type 2, and type 3 breaker structure in a different video. Okay, now this is more of a picture perfect example, right? Like I said, it doesn't move as easy as that. So what we see here is more of obviously what we'd actually see on a price chart. Okay, so the real life example. As you can probably tell, we're still seeing the swing points, the higher highs, the higher lows. But if you look a bit more closer within these ranges, you can actually see that there's much more noise. Okay, these minor structure breaks and so on and so forth, right? And this here is obviously what you would call a substructure. In simple terms, I mean, it's just a trend within a trend, but it's like, the way I see it is like walking up a hill. Okay, maybe not exactly like walking up a hill, but when you are walking down a hill, it's much easier to walk down a hill than it is up a hill, right? So that's what I'm relating to when it comes to just market structure in general. Okay, and you get the idea. But we'll generally call this just a complex pullback, because remember, if we are staying above the higher lows, then price is still moving upwards. But the minute price breaks a higher low, that's when the uptrend would invalidate and we would now be in a bearish trend. Now before I move on, I must clear this up. In order for there to be a higher low, there must be a higher high. In order for there to be a higher high, there must be a higher low. So if there is a new higher low that is still within the same range as the so-called previous higher low, that most recent higher low would not be a higher low, because there is no higher high. Okay. Now the reason for that is simply because this higher low is the general, the original swing point that broke the high structure. Okay. Now, if you hadn't already guessed, the difference between seeing a textbook example compared to a real example is that we're going to see the complex pullbacks, quote unquote, substructures within the ranges. Okay, so again, these moves here, what you may think is a retracement, is actually substructure within the overall uptrend. Okay, so as long as price is moving upwards and not breaking below the previous high low, we're still moving to the upside. Now, if we do break below the previous high low, would we consider this a bearish trend? A lot of you say, may say yes, but when we trade manipulation, especially in supply and demand, we understand that obviously there's a lot of manipulation. So this could just be clearing liquidity from the previous swing point, but it's still within this overall swing point. Okay, now the confusing part here is if I just clear them two lines, if price pulls back, creates a lower high and then breaks structure, that would now be considered bearish structure, and what we'd look for is obviously a pullback, a look to sell, and so on and so forth, right? But as long as, even if it's broken below the previous high low, we need to confirm that downwards movement. So we wouldn't consider this a bearish market until we've broken at least one and two lows. Okay. Okay. So moving on to bearish structure, or namely just a downtrend, this suggests that price is creating lower lows, lower highs and structure breaks. We still see that we create a low, then we pull back to the upside, essentially just retracing, and then followed by a new lower low, breaking previous swing low structure. Okay, then we again see a new lower high, essentially creating a pullback to the upside, followed by the same move, breaking a lower low to form another lower low, and so on and so forth. Now again, like bullish structure we've spoken about, this is more of a picture perfect example, and price, as we know, doesn't move as easy or simple as this may look. And as a reminder, we know when we compare things that look like picture perfect to a real life example, it never looks the same really, does it? So again, just to cover up, the LH means higher low. Okay, that's really big. If I just move that, so LH is a higher lower high, LL is a lower low. Okay, so as long as we're again breaking structure to the downside, we're still in bearish structure. Okay. Also, so pretty much price comes down, retraces, comes down, retraces, comes down, retraces, and every time it comes down, it is breaking previous structure lows. Okay, so like I said, when it comes to swing points, these are your swing points. Okay, all of these low highs, high lows, whatever, both bullish and bearish structure, all of these swing points is what we need to focus on. Okay, notice how I say focus on swing points. It's very important that we do this. So what we see here is a lower low followed by, it's dead thick again, I do apologize guys. So what we see here is a lower low followed by a lower high, followed by a lower low, followed by a lower high, right? And you see this pullback and what seems to be creating a lower high, then broken structure, creating a new lower high, which a lot of people will think that we are seeing higher highs, but in reality we know that this is just a complex pullback. Okay, complex pullbacks. So when price is moving down, what you'll see is, on the more real life example, is if I just delete all this and start again, when price is moving to the downside, we will see these pullbacks, right? And what we'll do is we'll start seeing these substructure breaks. Okay, and when we see these substructure breaks, a lot of people are going to think, okay, price is moving to upside, we've broken structure there, broken structure here, broken structure here. So a lot of people are going to be looking to buys, and their demand zones will most likely be failing. Okay, but what you must understand is price is overall moving to the downside, so we don't care what is going on within these substructures, because this is all just noise. And it's, you know, like when I go back to our methodology versus others, the overall general market, you know, the institutions are, you know, pretty much telling us to believe and to have an idea before one thing's towards one thing, then the complete opposite happens. So this is what I relate to when I say those type of things, okay? Because we're supposed to have a bias towards one thing, but then the complete opposite happens. So when people, you know, are seeing these higher highs being put into place on the smaller time frames, it's just noise, because we need to just focus on the high time frame structure. Now again, like I said, you can't take a trade within these. It's up to you. Just be prepared, and you know that you just added risk as well. And also, we know that price is going to reverse to the downside, because there's much more probability of price doing so because it's moving to the downside. Now, market structure is extremely important in obtaining our overall narrative, you know, in terms of how we should be surveying our points of interests, viewing the markets, forming our technical bias. Now you must understand that when price is moving to the upside, so in bullish structure, we ideally only want to be looking for buy opportunities, right? And when we're in bearish structure, we only want to be looking for sell opportunities. Now, I'm not saying you cannot counter trend trade, so sell within a bullish structure or buy within a bearish market structure, because of course you can, right? That's completely up to you. But you must understand that if we want to catch those bigger moves and even increase our strike rate or hit rate, we must be within accordance to the nature of the market. But it's completely up to you. Just be aware that you're taking on added risk, because if you're buying within bullish structure, we know that there is a high probability of it going in your favor, because at any point the price can make a higher low and continue to decide bullish trend. Okay, but when you're selling within bullish structure, we know that price is overall moving to the upside, so you have the high probability of being stopped out of a trade. Again, for one of my little cliche speeches like I always do in every video, it's very cringe, I know, but it's much easier to bike down a hill than it is biking up a hill. Okay, but seriously, just remember that the trend is your friend. Okay, so the moral of this video, is number 1, understand swing points. Number 2, minor structure breaks or substructure breaks is just noise, and focus on the outer perspective. Okay, number 3, try to be with the structure of the market. Again, if you want to counter trend trade because you want to be more of, because you may have more of an aggressive style of trading, so you may want to counter trend trade, that's okay. But if you're much more calm and collective and you're quite chill and you don't mind looking for opportunities every other day, then we're going to catch those bigger returns, and it's also going to increase our strike rate, so we ain't going to take on that added risk of being stopped out a lot, because we know that we're with the overall nature of the market. Okay, so this is why it's important to understand the general narrative of this of the market. Okay, so okay guys, I will be wrapping up the video here, and in the next video I will be jumping on to the basics of applying supply and demand within market structure. Okay, as always guys, adios.